All right, so the market followed up yesterday's advance with holding a lot of the gains, giving some of them back on the Russell, at least today's gains back in the Russell. Russell really had a good day today early before faltering late, and that's a little bit of a question in terms of how bullish it may be going forward. But at least the S&P, for the most part, held, especially held yesterday's opening gap, which we'll talk about in terms of our expectations here, but and held most of the gains throughout the day today. So relative, if you had to grade the response to yesterday's rally today, probably a B, B plus. You like to kind of follow up on it. Everybody wants the markets to go up a lot every day, right? And at least it didn't go down. Are getting some sector rotation. We'll break that down to what's actually moving these past couple of days. Breadth looked a little bit better, though it's starting to peter out. We'll talk about the implications that money flow and breadth has. Money flow is showing a divergent pattern. So we'll talk about what that means. And really, the question is whether this is a bullish move or a paper bull move, like a paper tiger. Is this a paper bull right now? This really loud bullish move? Is it a lot of, like they would say in Venezuela, pura bulla? Or is it real? And so we'll take a look at that and break it down in today's video along with our trade idea as normal. So let's go ahead and get started. Today is Wednesday, November the 15th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stands out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including the Market Outlook live video. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button as well. Again, the more you do that, it helps get our content out to more of our followers on these platforms. The more likes and shares and retweets and comments. That's why we always ask for it. Our goal is to get to 100 likes every day. We almost got to 80. I've been in the 70s pretty much every video here. So let's see if we can get to 100 on that. Again, thank you those who like it every day. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's take a look at the market, the S&P 500 with the market forecast indicator, and you can see the rally that we continued. This has been 13 days now, 13 days, because that was a Friday. Yep, that was a Monday, so we're going on 3 weeks, 13 days to the upside. Intermediate line well above the 90th percentile and 95th percentile. The near-term line in the upper reversal zone, good bullish move here. And of course, the momentum line did get to extreme highs there on the 10th. I think that was for last Friday. And the near-term line followed suit, and now your momentum line's back into bearish territory with a really, really small range, about less than half of what the average is. Over 4%, 4.5% above the moving average, being largely driven by the NASDAQ 100, of course. The NASDAQ 100 is nearly 6% above its 30-day moving average. It's very similar, except the momentum line is in oversold territory on the NASDAQ. It's a little bit more bearish there. The Russell 2000 has been trying to catch up the last couple of days. Not a very good candle here. Not very good to get a long upper shadow by the end of the day today. Because of that, I mean, we were actually pretty bullish on short-term sentiment. The momentum line ends up coming down now. The near-term line is still well above. The intermediate line is between 20 and 80, so we have to watch for when the near-term line breaks through below that. As of right now, it's in the reversal zone, and we'll see how long it stays. It is now 5%, so in 2 days, we've gone from below the 30-day moving average to 5% above it. Just in 1 day, we went from below it to 5% above it. So big, big move there in the Russell to kind of try to change things up. You are above the 38% Fibonacci retracement. We got to the 50 today, only to pull back down. Just for some context, this is on the 38% retracement of this decline. If you look at what the retracement is of the decline we've had here, and let's just go all the way to the high, since it's not that much bigger. Here we go. I'll move this down here. Just for some context, we're at the 78% retracement level of this of the S&P's decline. Remember this. So the Russell is just barely at the 50, and actually came off of the 50, but the S&P is at the 78%, and then when you look at the Nasdaq 100, it is above. Well, it's not quite. It's at 100%, but pretty darn close. When you look at it from here down to here, we are easily above the 78%. And nearly at 100%. So you see the vast difference there between these indexes down to the Russell 2000. So it's been a catch-up mode for the Russell, but it's got the most bearish candle there. That long upper shadows can be bearish when you've had a bullish move. So we'll see how that plays out here going into the end of the week. Let's take a look at the weekly chart here. And you notice that, again, very strong bullish candle. I think I've mentioned to you before on this, but it's a very similar setup to what we have over here in March, where we had a big transition candle that was a big bullish candle, right? So this big bullish candle on 314, very similar to 1030. That ended up producing a Hakinyashi kind of doji pattern, 314, 1030. And then we got the bullish reversal, the next candle closing above the high, and then we got a higher high and a higher close the week after, which is this week. And then it was a week after that in March that we started to falter, and we'll see if by the end of the week we start to falter here. Back over there, we kind of did the same thing. We came down to zero on the PPO and bounced, right? And we didn't bounce up very much, and then we finally rolled over. Here we didn't quite get all the way to zero, but we did drop the Hakinyashi close easily below the 40-week exponential, just like it did over here. And then we're bouncing. And the question is, are we going to bounce up a little bit like we did back in March 2022, or are we going to continue to move up? And, again, we had a very strong candle. We had a big candle sizes over there. In fact, that was the biggest candle that we've had in a while there. And it's kind of similar here. This is the biggest candles we've had here in a while since this bullish trend started. So we typically don't get these kind of big bullish candles unless we're coming off of some significant lows. And that obviously was not the case this go around. So when you look at the 3 green arrow charts, of course, 3 green arrows across the board. 3 green arrows now on the Russell. We didn't have that before, but now it is back on the Russell. So 3 green arrows here across the board. The MACD on all of them are increasing. So you have the green bars, except for the Qs, a little less bullish there in the Qs, not very much. We are well above moving averages on the S&P, way up above this. The 8 and 17 across, way above the 30. The MACD itself is in the 93rd percentile, so it's a very high level for the MACD here. Again, we got there back on just again for some context on how often we get up into this. It's the 85th percentile the past 2 years. If you look back here in March. It's about as high as we got there too, a little bit higher actually in March of last year. So a lot of people look at this move as like we've never had this move before. Well, we did have this move twice last year in August and in March, and it was actually more bullish both those instances. So this is hardly a unique move, not at all, right? And neither one of those two. I mean, this got above the 200-day moving average and it failed, and of course August got you to it and failed. We're well above the 200-day moving average after having been below it slightly. And we'll see if that ends up failing or not. Of course, the Russell 2000 had been well below the 200 and so far is failing at the 200. So last March, it didn't even get to the 200-day. Remember, the S&P got above it. And then in August, it got to the 200 just like the S&P did. But you can kind of see here, remember, the S&P is well above its 200-day. And IWM is not even, like it failed today on an intraday basis at the 200-day. And we'll see, ultimately if it fails. Again, very similar to March, right? It's almost exact kind of move that we see here. Looking at the other oscillators, they are bullish, above 30, below 16. If you break this DMI in half, so we cut it from 14 to 7, to kind of look at the short term, again, we're getting orange arrows here, so very extreme to the downside. We've seen this before when we've been. Again, we saw that back in last March too, right? We saw that back over here. We got one arrow back then with the positive up above 40, and the ADX got above 40, and that's where we're at right now. So big extreme move we've seen before. Again, looking at IWM, which had been more bearish, you can see it finally has joined the party. So it finally got easily above 30. In fact, got all the way up here to pretty much the highest levels it's been this past year. You can see it peaked when it got to these levels in the past. It peaked there, it peaked here, it peaked here. It did not get this high in March, so this is a lot higher. But you can see the negative indicator is the negative indicator is barely below 20. Over here it was easily below 20. On this one it was way below 20, and on this one it was even further below 20. So this is the highest level for the positive, with the lowest level of the negative, right? The highest level for the negative, is barely below 20 there. So kind of interesting how that's set up on the Russell 2000. This is one of the few rare instances that the RSI got above 65 and the CCI did not get above 150. These are two separate oscillators, but they kind of work well together. They tend to confirm each other or not. In this case, they're not confirming. I mean, this is a big bullish pattern. That's why I kind of got it white, right? It should be turning green here. But the problem is it hasn't been confirmed by what we're seeing on the CCI. The CCI still remains in the sucker zone between 100 and 150. That's bullish. It's not bearish. It's bullish, but it's not bullish enough to be trending to the bullish side. And so that's kind of not a good sign when you're trying to actually break out to a bullish, to a new move. And of course, the weekly CCI we watch to get above positive 100 to change the weekly trend to being green now, similar to some of these bounce. I mean, are we going to bounce up here like we did here and now we're turning green? Well, remember over here, we did get above 100 on the CCI. On some of these others, we actually got above CCI. In March, we did not. And we'll see how we end up the week to see how close we are. And you can see the CCI, or the RSI, not yet above 60 on the weekly chart. So not quite confirming there yet either. But it could, right? It could confirm it as early as next week. Well above the cloud. We've gone through the pink cloud. We've got a green crossover now. So now we're 26 days away. By the time we get to there, we should stay above here. That kind of changes the trend. When you get above we cross through the pink, by the time it turns green, we should stay above the green. We have an intermediate trend strength. Everything looks good there. The Russell 2000, not quite, right? You have a positive rate of change. You're into the cloud. You do not have the green crossover yet, and you don't even have you have a weak bullish trend, a very, very weak bullish trend. And again, that's it. So you can see the difference on these oscillators. The S&P is barely into the upper quartile. Still, it's kind of in between the 75, not into the 90s. You really have to get above 100 when you're starting a new bullish trend. And here's something interesting too about the Bollinger Bandwidth. We haven't crossed above the 150-day range for the bandwidth to the upside on a bullish move. It's always been on bearish moves. Anytime we've crossed up above and started to increase the bandwidth, anytime we've crossed up above, crossed up above, crossed up above, crossed up above. The last time we crossed up above with a bullish move was right here in the beginning of 2018, when we made this run first in late 2017, then 2018. That's really when we made that big crossover right there. And you can see that was also kind of a crazy move to the upside. And then you see how it just failed really badly. So, again, that's kind of stands out to me as something here, it's not typical to cross up above pretty significantly to the upside on the bandwidth from a low bandwidth level with a bullish move on the stock. And again, if you look at where we are in the Keltner channels, we're well above the Keltner channels. And if you go back to March of last year, that's when we peaked. When we got above the Keltner channel is when we peaked. When we got above the Keltner channel here in August is when we peaked. And so here we are now above the Keltner channel. Is this where and when it's going to peak, considering it's not above the bandwidth? And you have very, very strong momentum here that looks like, that's about as high as it gets if you follow my cursor over to the left. So really interesting patterns developing there in terms of how bullish we really are, especially with this gap that's just sitting there. That's a common gap. We didn't break away through a significant resistance. It's more likely to become, because we've already had a runaway gap there, so this is more likely to be a common gap. There's still this common gap from back over here, on the Friday when this kind of was all starting. Remember, the Russell 2000 did fill in that Friday gap. Here's the Russell 2000. It did fill in this gap here, and you can see how big that gap is for the Russell if it were to fill in. And you can see the downward move we had coming off of the high, not necessarily the most bullish pattern there. So, we did get a higher high, we did get a higher low. The Russell did close above yesterday's high. The S&P did not, right? But it was very, very small range, and this is this gap is there for filling. So we're really susceptible to that kind of move, and then depending upon how much more we fill in, because technically we haven't filled in this common gap from last Friday. I doubt we'll get there by tomorrow, but I wouldn't be surprised if by the end of the week, going into options expiration no less, that we fill in this gap, and we are heading into options expiration, which kind of stands out too, because if you look at how much we've rallied so far on this during this expiration cycle that's about to end, it is one of your biggest moves that we've had. Let's see here. I don't know if it will let me do a log scale, but let's see. Yeah, it doesn't do a log scale on these, unfortunately. So it doesn't really adjust, but again, obviously we had a big, after COVID, we had a big move there, 25%. This one looks a little bit better, but you can see now this is one of your biggest moves, and going into the options expiration cycle. Here was the last one going into that August peak, and you can see what the next expiration cycle looked like. Even this one here, the next one was bearish, and of course this one was again coming off of the COVID low. Much higher volatility. Look at the gap we went into that expiration cycle with. We gapped up 2.25%, so we finished here. We gapped down this one. Some of these others we did gap up too. So this is a really, really good move coming off of a gap to open up the month. But if we finish here a little bit higher, we're susceptible for a move back down, considering that we're going into this options expiration cycle at the peak of it, right? So we'll see if we end up filling this and how that impacts the monthly return by the time we're done. If you look at today's volume and range, it was very, very low, very, very low. So below average. We did get a little bit above average on the CPI data, and of course yesterday's range was big when you include it was really small when you include the trading during the regular session, but today's range was even smaller than that. So very, very small range, below average on the volume, and you can see the range is still pretty large. It's still above 1%. It's got to get back below 1% for us to be kind of like out of bullish mode. And then you can see down here the volume is still relatively high compared to where it's been. Of course, when you normalize that volume with the price, again, we're still like, you can see the money flow, which is what money flow is. It normalizes the volume by the price of the stock. So you can kind of try to compare apples to apples. We're extreme levels on the oscillator here, which, the highest level we've seen in the past year, and the highest level, I think, since August. I think we got there in August, but even this is even higher than that. So this is the highest level of money flow in the past 2 years on an oscillating basis, because we came off as such a low point there. But if you notice here, and let's just go back to 1 year so you can see a little bit better, this peak in volume that occurred right there on this date, we are way up above it on price and nowhere near, like we're not up above it on the money flow. So we're lacking in confirming this move, this dramatic move, as dramatic as it's been. And again, usually when we get these high extreme levels, at best we flatten out from here, if not peak and roll over, because of, again, how extreme the money flow was to get to this point. And it's still like, and again, it was as extreme as it was, it still didn't get up to new highs, right? You got lower highs, lower lows, everything was following suit until this move, right? This move went up through this high point, and it's actually kind of matching up really close. In fact, pretty much, see, we closed there at 450, so we're just less than $1 off of this close. So we should be close to this peak in volume money flow, if not above it. And again, we're not anywhere close to it. So you see how, we're lacking pretty significantly in confirmation Looking at the volatility index, this is also another big red flag about this market. The VIX has been dropping like a rock, mostly last week, not so much this week. But as the VIX has continued to drop, the VVIX has not. The VVIX has been rolling up, and that's brought the correlation between the VIX and the VVIX down to close to negative levels. It's typically very strongly positively correlated when you look at it on a longer term basis here. You can see it's typically here. Let's go out 2 years so you can see a little bit better. It's typically pretty positively correlated, and when it is negatively correlated, it typically sets up, for a move higher. This one's set up for the banking crisis volatility move. This one's set up for this volatility move, and then now you can see very strongly positively correlated as it is on a quarterly basis, but not on a 10-day basis, right? So we are, here setting up for a move higher in volatility off of these lows that are pretty low, and you can see that's well below its 200-day average here. And we have had the change. The 8 and 17 are above the 30, so I wouldn't be surprised if we got to ramp back up above these two lines here, so above 16 and a half on volatility sooner rather than later. Maybe not by the end of the week, but again, sooner rather than later. All right, now let's take a look at what's driving this price action. You can see the big rally here this past 13 days, right? It's taken over a 3-month period. It's taken the Qs from being down 7% to being now up 4%. The dollar and gold are still outperforming over the 3-month period. All the other equity asset classes. IWM is actually, despite this last little 2-day move, is actually still down 6%. Still, barely beating long-term bonds over this period, who are also off their lows, and V&Q is also off their lows. And as I mentioned previously, V&Q typically has been very correlated with the Qs. So interesting move that it's been making here recently. So over today, if we just look at today here, you can see, and really last 2 days, but if you look at today, you can see the big move higher in IWM, right? Catching up. Started the day much higher before pulling back and finishing the day pretty flat against the S&P and the Qs. EEM had a good day today. Long-term bonds were down big. Again, that's yields, right? Moving higher. The dollar was up. Yields are up. That's been a recipe for bearishness on equities. And equities weren't bullish, but they didn't go down either. So that's a relatively positive sign for the markets there. Looking at the last 2 days, again, you can see IWM just killing it, up 5.5%. V&Q also up. The Qs kind of matching the market returns, only at 2% gains. Bonds were up yesterday with yields down, but then bonds are only up about 1%. You can see the dollar being down, commodities being down has helped fuel a lot of that risk appetite. If I were to go back all the way to the last 3 weeks here, so if I were to come over here to the 30th, then you can see, again, there's that correlation with the Qs. You can see IWM had been lagging. They really caught up big time in the last 2 days. So now they're up 10. The Qs are up 10%, or IWM, is up 10% over this past 13 days. And then you can see what's driving this. Bonds are up, which means yields are down. The dollar is down. Commodities are down. That's your three-headed monster that for bearishness that's all been down here, and it's really fueled especially the yield move. The thing with the yields, though, is that yields are not dropping nearly as much as they have been. You can see that yields are starting to work their way up. The near-term line's down, the intermediate line's down, but the intermediate line's actually turning up now. It's got light green shading here, so it turned back up above 20. We'll see if the near-term line crosses below it or bounces up 2. If we were to get back above 4.7%, now we're looking at a move back above the 23% retracement of this bullish intermediate run that the yield's been on. So you can kind of see, it's like you wonder how much weakness here. And the dollar, which has been really weak, big time drop yesterday. We've seen it. Look at that big time drop we had in the dollar in July, and that failed, right? That actually sparked this big long run. We've seen kind of moves like this where it's like really abnormal. This is one of the biggest down days in the dollar that we've seen in just the 1 day. This is so far tonight, but this is that 1 day you can see being down over 1%. Look at, it's the biggest down day of this past year. Not including like over that, remember that period in July where it really took off to the downside and it failed like a fake out move. If you go back over here to October, the middle of October was the last time we had this big of a decline in the dollar. You can see COVID would be another period that we were a big move to the downside, to say the least, one of the bigger moves. And again, you wonder how likely it is to maintain this move, since it's already pretty much in one day filled in the gap between the 50 and 200-day moving averages. It didn't quite get down there to 200, but you see it starting, moves up today. It's already up tonight a little bit, not much. We'll see how much more downside there is now that we're back above the 38% retracement of that intermediate run that it's been on since that last failure of, more than just one day, but this was actually a 1 week failure to the downside. If you look at it on a weekly chart, it was a big failure. I mean, this is what the daily chart looks like, right? And it failed. And so I think we're set up for something very similar here where, even the last time we had a big down day, we rallied for a week, and we'll see if that ends up being the case this go around. If you look at some of the other signs, I showed you the money flow from a breadth standpoint. Again, you can see we are setting up for a bearish divergence. We had a bullish divergence. We had this big move higher, this big thrusting move higher, but we didn't have a washout on the correction. We never did get below minus 100, like we did say like in COVID or in the fourth quarter 2018. Even last October, we had a big washout here. We never did have a big washout move at the lows, like you typically get at the end of a correction. And yet we seem to have such a big move. But again, like last March, where we ended up with a little bit of a divergence, right? We had a big move higher and then a smaller peak there going into there. Same thing with the August move, big move, smaller peak, big move, smaller peak. We're getting a little bit of a bearish divergence. We're still negative on the summation index. So the breadth still isn't that great when you look at the new highs and new lows, right? We need to have positive new highs. Here's the number of stocks above the 50-day moving average. If you look at the number of stocks that are forming new highs, we're at 100. You can kind of see when we get bullish, we need to get through this 100 level and get a little bit higher than this. So let's see if we can follow up and actually build on this return. There we go. So we can build on this return or not, or if it ends up kind of stalling here. Which is my kind of expectation that will end up stalling. If you look at the skew, that's kind of an important factor. We're back above 138. We're back above the moving average. We're not really breaking out though. Again, you tend to turn bullish when the skew trends to the upside, like when this average trends to the upside. The problem is we're already pretty high. The average didn't go down very much like it did over here. The average already is, so it's kind of like, and it got to a pretty decent peak here earlier in the summer. It was a relatively big hot peak there. If you go back, if I were to zoom out so you can see some perspective on this, just how high that peak got to, right? Again, it's the highest level since before that fourth quarter 2018. 2001 obviously got about this high point, especially right at the end. And then we did again there too. So it limits the upside when there's not much, and that's kind of what you need. See these big moves come off of really low skews, and the skews trend up, and they trend higher and higher, and we go up and higher. And even this last one, we came off of a low, and we had a nice, good trending move on the skew. So again, with the skew already, with the average itself already above 135, and getting to 145 is a pretty decent high. Then again, limits our upside in terms of how much further it can go up. And then of course, as we've seen over the past couple of years, every time we dipped below 0.8 here, when there's been a lot more stocks above the 50-day moving average and above the 200, and we get this ratio below 0.8, those have all coincided with these peaks. This one just got below 1, it coincided with that peak. This one got below 0.8, coincided with that peak there. This got below 0.8, coincided with that peak right there. This one got all the way below 0.5, coincided with that peak. This got below 0.6, coincides with that peak. And then this one got below 0.9, coinciding with that peak. And here we are now below 0.8. What are we going to coincide with the peak, especially with the PPO for this average starting to fall down. See how low we are with it below falling down. So again, you see a lot of factors that suggest, this has been a very loud move, but there's not a whole lot of, again, is it a paper tiger? Is it a paper bull, right? Is there not a whole lot of toughness behind this move? Is it just loud? Is it like the Draymond Green of bullish trends? And that's the big question. And of course, I'm leaning in that direction. That it is the Draymond Green of bullish runs, and it's not necessarily the Steph Curry, so to speak, of bullish runs. All right, now let's take a look at the sector rotation, and you can see the 3-month sector moves here, but let's just take a look at the last couple of days. We'll go to November, and we'll just go to the last couple of days here. And again, you can see, real estate's doing very well. Utilities, interest rate sensitive areas, both doing very well. Materials, discretionary, financials, industrials. Again, not necessarily your big technology type areas. In fact, going to, for most of this week, technology actually, because of the Monday's performance, is actually lagging on the week. And so is communication services. They're not very much at all. Of course, discretionary is, but it's mainly kind of, the odd companies. That has not been the case for most of this run, right? For the most part, technology has been the big winner, and communication services and discretionary. It's been a late move of relative weakness in these and relative strength in some of these others areas that are starting to drive up here at the end. Again, the sector rotation suggesting, again, how much bullish are we able to go. Remember, from a rate of change standpoint, this is our rate of change right now over the last 13 days. 13 days here on the S&P 500. We're up nearly 10%. We're up 9.36%. That's obviously the highest 13-day move that we've seen in a while, right? We had to go in fact, you have to go back to that last March. Again, another indication of how very similar this is, where we were up 9.46%. And then, of course, back over here when volatility was a lot higher and we had 0% interest rates for a lot of these moves. In fact, you could argue that we shouldn't have this big of a move now versus even 2022, because this was after just one rate hike of 25 basis points back in March. We obviously have much higher rates now. So it's not like we all of a sudden gone accommodative, or we've lowered rates, or we've ended QT. None of those things like that. That's all what happened on some of these other moves, not this go around. And yet you can see after these 9% moves how we quickly shifted. In fact, if you look at, so by the end of the week, which is 15 days, again, if we were to finish flat in 15 days, here we're at 9.36 now. This is the return so far. So this would already be one of the biggest 3-week moves that we've had going back to last March, and even eclipsing some of these other moves that we've seen, again, coming off of accommodative monetary policies and 0% interest rates over here and other things. Again, opposite view that we're getting right now in the markets, where CAPE ratios are really high, and CAPE ratio was not at 30 over here like it is now, was not at 30 over here like it is now, among other things, right? So that's the picture, right? And again, you can see after all these other moves, eventually we had a 3-week decline of 5, 6, 7%, or even over here, at one point you got a 5% 3-week decline, and eventually you started, ended up with about a 5% 3-week decline over here too. So, at some point in time, especially here lately, we, these 3-month rallies turn into 3-month declines, and that's kind of the expectation here. Again, potentially not the next 3 weeks, but within the next 4, 5, 6 weeks, we should get a 3-week decline in there of 5 to 10%, most likely based off the type of rally that we've had over the past 3 weeks. All right, that brings us to our trade idea of the day. And let's take a look at Etsy. Etsy is a stock I've been looking at here. You can see the intermediate line crossing above 50, so getting dark green shading, just getting above the moving average by 11%. So clear, well above these highs where we got the bear tags. So pretty clear move, bullish move up to the upside. Near term line getting back into the oversold zone. Intermediate line, so market sentiment line, excuse me, so oversold, but starting to turn back up and and moving up to the upside. If you take a look at like the weekly crossover chart, you can see that we got a bullish candle for the first time in a while. We got a green arrow for the first time in a while. The PPO is way down at 20%, starting to rise up to the upside. Obviously, we have 3 green arrows on the stock. If you look at, again, clearing through this high point, well above the 50-day moving average, getting into this range between the 50 and 200. MACD getting up to high levels. Stochastics also moving up to a high level there. Looking at the DMI, you got a breakout pattern here on the DMI, well above 30, below 20 on there as well. RSI is also showing bullish patterns, well above 60 and 200 on the CCI. So clear bullish moves there. And if you look at the weekly version, we haven't even gotten to 100 yet on there. And so we could be sparking a new bullish run from that perspective. Looking at the Ichimoku cloud, we are into the cloud now. We had been using the cloud for resistance. We're into it. We don't even have a weak trend developed yet. Very strong positive rate of change. So we're not the most bullish, but you can see how we're turning around well above the upper Bollinger Band, also above the Keltner channel too. So we close above the upper band and the Keltner channel. We haven't even turned green yet, so the bands are still inside the Keltner channels. So we may just be getting started here. So what I decided to do was to sell the $80 call, buy the 75 put. This is what it looks like here. Selling the 80, buying the 75 gets you this. The move comes up here, this maximum gain. That's, if I position size, it's almost a 3-to-1, about a 2.5-to-1 reward to risk ratio. And then you can see all we have to do is get above 80, though one standard deviation move right now is getting up to 82 by December expiration. So we have to get up into this area. But considering the breakout patterns on some of these oscillators, that seems to be a likely proposition. Obviously not 100%. That's why we have to put position size. Otherwise, I'd put my whole account into the trade. But pretty decent opportunity, pretty decent reward for the small amount of risk that we're taking here. All right, that wraps us up for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember, subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.